We have been talking about and preparing for market volatility all year long, and it looks like we're finally seeing that. And the reason that we've been predicting it is because, first off, market volatility is normal in any given market year, and we haven't seen it in 2024. The market has really just been really up so far this year, and that's not normal. In any given market year, we tend to see volatility, and it's also an election year, and election years tend to be more volatile than average. We tend to see a correction, negative returns leading up to an election, and then we tend to see a recovery post-election day. So looking just at historic returns alone and general market cycles, we would expect this year to be more volatile than normal, and we would expect this year for there to be a decline leading up to the election day and for there to be a recovery post-election day. The other big reason is because of interest rates. We've been talking about interest rates for a long time, but in order for the Feds to really be able to lower rates, we need to see some financial and economic pain in our world and in the stock market. It just doesn't make sense that the Feds can lower rates if the economy is booming, if we're continuing to spend money, we're all feeling really financially healthy. If the Feds lower rates, all that's going to allow us to do is to now go borrow more money, make those big purchases that we've been waiting on, buy the house, refinance, buy the car, and now that's putting more money into the economy and spurring inflation. So we really need to see some financial and economic pain in our world for the Feds to actually be able to lower rates and in turn get us back to a more normal market condition. Now, we want to see rates come down, so unfortunately that might mean that we have to go through a market downturn. We might have to go through a recession. We shouldn't be so scared of that word. Mild recessions are very normal. We can get through a recession relatively easily, and recessions historically have been followed by great growth in the overall economy and in the stock market. So one thing for us to just be prepared for is that this volatility and this potential economic pain that we might be experiencing, that we might see. And we really want to look at this volatility as opportunity. We talk about that all the time in our world, understanding that market volatility, market downturns, negativity is really a good buying opportunity because it means we can buy in at a much cheaper price. And that's a really, really good thing. And it also means that historically, the worst days in the market are followed by the best days. They're followed by a recovery cycle. So if we can buy in at a cheaper price, then we can get to experience that recovery and get that growth along the way. So right now, what we're really looking at is a lot of people who have cash on the sidelines because interest rates have been high. We have 5% returns in just cash accounts right now. In money markets and high yield savings accounts, you can be getting 5%, and that's amazing. We haven't seen that in years. So there's a lot of cash on the sidelines. What we need to realize is that if we continue to see negative market returns, if we continue to see this volatility, if we continue to see, headlines that are really fearful and scary, it's going to allow the Feds to be able to lower rates. When rates get lowered, guess what? Your money market and your high yield savings rates are coming down too. So you're not going to be getting that 5% anymore. The worse the headlines are, the worse the stock market performs, the more likely it is that the Feds are going to be able to lower rates more drastically. So if you start really seeing returns in the market, markets down 10%, 15, 20%, if we see anything big like that, you should realize, hey, that's going to allow the Feds to really drastically lower rates, which is going to mean that my cash on the sidelines is not going to be earning much at all anymore. We're going to go back to pre-pandemic levels where I'm not really earning anything for my cash. Now, you should always have an emergency fund. You should always make sure that you have enough cash to get you through any loss of job or any major emergency. But if you have cash above and beyond that, we should be thinking about, hey, I should take advantage of this opportunity in the market right now. I should be buying in at a much cheaper price at this 10, 15, 20% discount, whatever it is that we may be seeing, because we don't know, one, how long that downturn is going to last, and we want to take advantage while we can and participate in the recovery cycle. Also want to share a few slides just to put that into perspective a little bit further, because I know it's easy to hear that. It's a lot harder when you're actually going through the emotions and you're listening to the news and you're looking on X and you're seeing all of these crazy things around the market and what's happening. These headlines that sell, these headlines that play off of fear, we really need to sometimes see some actual data and go through some historic figures to put things into perspective. So I really like this chart because it just reminds you that in our past, when we went through some significant life events that really felt like this time was different, that really felt like we're never going to recover, we have. You look back at some of the worst events in our history that at the time felt like we would never recover. As you can see, this is just showing the growth of $10,000 if we had just stayed in the market and we just rode out all of these crazy events, all of the market volatility since 1970, that $10,000 would be $2,759,000 today. And that's going through all of these events that felt like the world was ending. COVID felt like the world was shutting down and we had never seen it before. We were never going to recover. We go through 2008 and the financial markets going through a crisis felt different than every other event because it was actually the banks that were shutting down. It was the financial markets that were shutting down. We'd never been through this before. It felt really, really scary. And, we go through 9/11 and the tech bubble bursting, wars, things that really, really at the time felt like we had never seen it. We would never recover. Putting into perspective, we always do. So this time it's going to feel different. It's going to feel new, like it's not going to follow those same cycles, like we're not going to recover. And again, one of the biggest things that we can learn and overcome is that belief that this time is different. One of the most important things that we can do is just stay the course and not let fear take over. And this is just showing that in a different way. Again, just reminding you that, hey, volatility, negative returns are normal. We expect to see them every single year. And again, just reiterating, 2024, we really haven't seen much negativity. We really haven't seen that volatility. So far, the market's only been down that 5%. So it's likely that we still have some negativity to go for the overall year, but we actually still expect to average a positive year overall for the calendar year of 2024. Sometimes during these fearful periods, people will think that, hey, I just want to pull out of the market and move into cash, move into something safe like gold. We should be invested, just in real estate. And again, it's just showing that historically, riding the ride and just going through the ups and downs, stocks have won out, and pretty drastically compared to cash or gold or home prices. Other thing for us to understand is that bull markets have lasted historically way longer than bear markets. And that is really crucial because I think, again, fear sells. It's really easy for us to get caught up in the negativity and feel like we're always going through kind of downturns in the market, these really fearful times in the market. But in reality, bull markets are more popular and more common than bear markets, and they last longer. The average bull market has been 4.3 years. The average bear market has been less than a year. Right now, we are technically in the second year of a bull market, so it is much more likely that we see more years of this continued bull market than we see another bear market. The other big thing, you see this chart often, I've talked about this a lot if you've been working with me for a while, missing the best days in the market is really, really crucial because what a lot of people think they can do is they think they understand this concept enough. They understand that they should not be selling out when the market is at the bottom. They understand that they should be buying in at the bottom. But what they try to do is in preparation for the bottom, they'll try to sell out when things are good, and they'll try to just sit on the sidelines, wait for the market to bottom, wait for there to be a good buying opportunity, and they'll try to buy back in. And they'll think they're being so smart by doing that, right? That's the name of the game. Buy low, sell high. I should just move all of my money into cash, and then I'll be ready to take advantage of that downturn. The problem with that is that it's really, really hard to predict the bottom. People spend their entire lives trying to do it. Very, very intelligent people, now technology, computer algorithms trying to predict it, and they get it wrong, and they get it wrong often. And the other big thing is that the best days in the market are followed by the worst days. So that makes it extremely challenging because one, you don't know when that worst day was, and two, if you miss just one of those big recovery days because you were waiting to see when it was going to make sense to put your money in, you miss out big time on long-term returns. And you can see that with this chart here. This is just showing the difference if we had just stayed invested back in 79 to now in 2024, $10,000. If we had just stayed invested throughout that time period, we would have $1,575,000. If we miss just five of the best trading days in the market because we were trying to time the market and we were sitting on the sidelines and we happened to miss it, we didn't time it correctly, that's an over $500,000 difference in returns. Media tends to focus on the negative sells, and in reality, the market is actually up way more than it is down. The market has been positive 72 years and only negative 26 years. The average return is 21.4% on those positive years and only 13.4% on those negative years. So again, going back since 26, the average return is 10.3%. We have to go through some of those downturns, but again, just remembering that it's actually more likely than not that we see positive returns than negative. And this just reinforces that. This is actually one of my favorite slides because it's just showing your probability of getting a positive return given these different time frames. And you'll always hear, what is your time horizon? Because how you should be invested should be dependent on how long you have to stay invested. If you have a long-term horizon, if you have 10 years that you're comfortable with this money being invested, or you don't need that money until 10 years down the road, you have a 97.4% chance of positive returns. Those are really, really good odds. In a 1-year time frame, we're almost at 80%. 77% chance that you're going to see a positive return in just a 1-year period in the stock market. So yes, if we're just looking at those short-term day-to-day returns, 53% chance that we might see a negative day or a positive day. But if we just give ourselves time and we just allow the market to do what it's going to do, allow it to go through the ups and downs, we have a really strong percent chance that we're going to see positive returns. So I hope that helps you put the market into perspective, put what's happening out there in the world into perspective, and help you stay invested. And also, if you have cash on the sidelines right now, if the market continues to come down, if we continue to see this economic pain in our world, it's more likely that the feds can then lower rates. I'm going to be getting my 5%. I might want to take advantage of this opportunity, buy in at a much cheaper price, and be able to take advantage of that recovery cycle whenever it does come. So if you have questions, if you want to talk through any of this more, if you have money on the sidelines that you want to get invested, please reach out. You know where to find us. We're always happy to help.